So there were good evening everyone. So there were around 140 odd people on the group, and around 59 I can see have joined. So let's wait for just 2-3 minutes more. Once more people join in the next 2-3 minutes, we will start.
हाँ मंगेश, हेलो हेलो।
Good evening, sir.
Good evening. Am I audible?
Yes, yes.
Very much, very much.
Okay.
Yes, yes.
Tell me when to start. Huh?
Hello, hello, hello. Hello everyone. Wish you a very good evening. Hello everyone, am I audible?
Yeah.
Yes, Atharva.
Hi,
Yes, yes, audible.
good evening everyone. I am C. Atharvapte, Secretary of Thane Branch. Uh, First of all, wish you all a very good evening and warm welcome to our seminar on Union Budget. We had planned to keep this as an offline seminar, but unfortunately because of rains, we had to shift this online. So sorry for the inconvenience, but thank you for being here. Welcome one and all. We'll officially start the program. Before we start with the speakers, I would request our Chairman of Thane Branch, CA Mangesh Ganekar, to give us all the opening address.
Thank you, Atharva. I am audible, right, Atharva?
Yes.
Yes.
Yes,
Yeah.
you're audible.
Yes. So, good evening, everyone. As chairman, myself, CA Mangesh Ganekar, would like to welcome you all to this session on Union Budget 24. Like Atharva mentioned, we were initially going to have this session physically, but weather has played a spoil sport in our plans. Nonetheless, I can see many participants from across the region, from outside of Thane as well, in the on the screen. So in a way, it is good that we have kept this virtually so that maximum professionals can take advantage of this who would have otherwise not joined us physically. So it is a boon, in fact, we can say. Uh, I think this must be our first session in the region to have an in-depth analysis of direct and indirect tax provisions in the budget. Many sessions were planned yesterday and day before by various forums, but they were all a first cut analysis or initial thoughts on budget. So we should really commend the efforts taken by our speakers, CA Anil Sathe sir, CA Omkar Gadge, and CA Swapnil Kolte, to come up with an in-depth study within 1.5 day of the budget presentation. So we should really thank them for their efforts that they are taking for all of us. Though the budget speech was the second shortest speech by the finance minister, the fine print of the finance bill says otherwise. There are huge amendments, especially on the income tax side, and we really cannot wait to hear from our learned speaker. So I'll not take much of your time. Before concluding my opening remarks, I would just like to update you about two major conferences that are being planned by Thane branch in the month of August. One on 10th of August, which is Falcon Phone 4.0, This is a national conference for women CA, and then we have our flagship conference, Taxathon, which is again a national conference on direct and indirect taxes, which is planned on 30th and 31st of August. So I request all members to participate and take advantage of the enlightening sessions being planned in these conferences. With this request, I request our branch secretary, C. Atharva Apte, to first introduce our first speaker, C. Anil Sathe sir, and commence today's proceedings. Thank you.
Thank you,
Mangesh.
So to introduce the first speaker of our day, C. Anil Sathe. He is a FCA, CS, LLB, and BCom by qualification. He has been practicing since 1982. In his professional achievements, he has been a past president of Bombay Chartered Accountant Society and former editor of the Bombay Chartered Accountant Journal. He has published articles in professional journals, including BCAS, the Chartered Accountant, Income Tax Review, and in Economic Times and magazines. He has also been a co-author of publications issued on new scheme of taxation of firms and voluntary disclosure of income scheme 1997. He has presented papers at residential and non-residential refresher courses organized by professional bodies. He also delivered many lectures as a guest lecturer at JBIMS for Income Tax Department National Academy of Direct Tax Nagpur and for Regional Training Center in Mumbai. He is also a panel member of the Charitable Trust Clinic conducted by the Bombay Chartered Accountants Society. Anil sir, I request you to kindly take up your session.
Okay, you have given me sharing rights also, no, Atharva?
I think the branch must have shared it with you because I think
Yes, sir. Yes, sir.
Okay, okay. Just stop it.
नहीं मैं खाली
बेटा stop on this one. One second until I set my PPT.
Yes, sir.
Oh.
Hello.
I'm really delighted to see almost 100 people attending this session despite the July 20. This is July 25th, and we are at the peak of our season, tax filing season. But sir, to listen to you, everybody has gathered. So the slide is visible.
Yes. I hope I'm now audible. Hello.
Yes, sir, you are.
Yes. Yeah. Okay. Thank you for calling me. I think I have come to Thane on innumerable occasions, and the prime reason why I'm here is I have made a promise to Kalpana that till she keeps inviting me and keeps tolerating me, I would be willing to come to Thane for this budget lecture. I've lost count of the number of times I've come. Must be at least 5 to 7 times or even more. As far as the chairman of the branch is concerned, Mangesh, I often have heard him, and I have often felt that he's in the wrong profession. And because I heard him at Shivaji Park Study Circle maybe a month ago, and he was singing so beautifully that I felt that he should change his profession to that of a vocalist. This branch has a special place in my heart. As I said, I have been speaking at public fora for more than 35 years of my 40-year career. And Thana was the first place where I came to speak. And I do recall the fond memories from that point of time. Thereafter, the Thana region has been nurtured. You have today a person like Mangesh, who is in the Central Council. You have Mangesh Ganekar sharing the same name, dealing with the branch. As I said, I've been coming here to speak on the budget. And this year's budget, in fact, gives, a lot of things on which we can really speak. I must, before I start, because I think, Mangesh, we have around 1.5 hour. How much do we have? Mangesh? Okay.
Yes, sir. 15 minutes
Around,
we can.
around 1.5 hour?
वो 1.5 तास सर 1.5 तास.
Okay, okay.
Yes. Thank you.
So as I said, and please let me know, because at times the internet connection goes unstable. If you are not able to hear me, please do let me know.
Yes.
As I said, my team, my partner Chaiti and my juniors Pallavi, Lavina and Parna have prepared this PPT. For the reason that this time we had a very small gap between the actual presentation of the finance bill and this lecture. So I took their assistance, and I reckon they have done a very good job. Before I get into the PPT proper, I would say that there are around 9 areas which I would be covering in the next maybe 75-80 minutes or so. What is my first impression of this finance bill? My impression is that possibly the finance minister could have done more. She did say at the beginning of her talk that within a period of 6 months or so, there would be an overhaul of the Income Tax Act. Frankly speaking, I don't know whether that is really called for at all, because I believe personally that this particular act has served us well, and there is really no reason to go in for a complete overhaul. Yes, it does need some degree of, shall we say, calibration, which is being done from year to year. I have always in my budget lecture said that whenever a finance minister says that I want to simplify the law, it is a dreadful thing, because if my understanding is right, tax laws can never be made simple. They can be administered more humanly, certainly, but if laws are simpler, they would be vague. This is an act that has served us for more than now 60 years. And I don't see any reason to, overhaul it by a new statute. In the civil side and the criminal laws, we are going to face difficulty in the next few years on account of the new laws that have been brought in. As a citizen, I would believe that there is no real need to change these laws. As a tax counsel, I'm more than happy because every year in our office we discuss as to whether litigation is going to survive for more than a few years. And I tell my juniors that they need not worry. According to me, the way finance ministers over the last decade and even earlier have been bringing forth amendments to tax laws, I can safely say that next decade or so, we will have plenty of litigation. As far as this finance bill goes, as I said in this slide, I am covering around 9 areas, and we will go to the meatier ones. We will begin, of course, with the tax rates, which I don't need to dwell upon for any length of time. There are marginal changes. AY 24-25, the rates you all know, from 24-25 to 25-26, effectively in what was earlier called a new regime and now is the default regime. There is an increment on the minimum basis from 3 to 5, it's become 6, 6 to 7 has become 9. Otherwise, the rates are virtually the same. So we don't have much of change as far as the tax rate is concerned. So even the surcharge remains constant. Therefore, and we'll dwell upon it when we go a little further, we must thank the finance minister for not increasing the surcharge on dividend, because as you will find, certain incomes which were hitherto characterized as capital gains will now be characterized as dividend. So the surcharge on dividend remains at 15%. Everything else, all the tax rates are constant. So we will straight away go. Yes, incentive to salaried employees, there is a marginal, shall we say, relief in terms of increment of standard deduction from 50 to 75 lakhs, 75,000. There is a small relief by way of a deduction in 50sin 2A by way of increasing the limit from 15 to 25,000 under the default regime. Also, as a boost to, shall we say, the recognition of the fact that there has been a reasonable amount of inflation, and therefore one must protect the retirees. You have the non-government employer contribution to the new pension scheme having an incremental deduction now from 10 to 14%. So these are, shall we say, the amendments in regard to rates and the smaller amendments regarding to salary earners. With that, let's straight away get into the provisions in regard to capital gain. And here, the finance minister has sought to make large number of amendments. The amendments I have tabulated here: 242A, which is the holding period; 48, which is the mode of computation of capital gain; COA, or the cost of acquisition, section 55; the rates of capital gains, 111A, 112 and 112A; then the special rates commencing from 115AB and going to 196C, 50AA, and the amendment to section 47. We'll begin with 242A, the holding period. You had a virtually settled position by virtue of which you had listed securities or listed shares having a holding period of 12 months, unlisted shares and immovable properties having a holding period of 24 months, and the balance of holding period of 36 months for the purpose of treating a capital gain as a long-term capital gain, which enjoys a concessional rate of tax. Now that has been sought to be done away with. The holding period has changed, and hitherto we had a holding period which used to change from year to year. But now you have a holding period which changes from a date that is 23rd of July 2024. You have a change in regard to units listed on a recognized stock exchange, which was either to 36 months becoming 12 months, and the unlisted shares and everything else becoming 24 months. The listed now is still 12 months. So you have now two holding periods. For listed securities, including units, you have a period of 12 months. For virtually all other asset classes, you have a period of 24 months. So this, according to the finance minister, is simplification, and it certainly is that, yes, to an extent that you had three holding periods for something to be defined as a long-term capital asset. Now you have two, 12 months and 24 months. But mark the difference. We used to look at holding periods in regard to an entire previous year relevant to an assessment year. Now you will look at the dates. So this is the first change. And mark my words, what is really going to be of significant importance is that you will now have to look at the date of transfer. Therefore, the determination of date of transfer was always relevant qua a year. It is now relevant qua a date. To give you an illustration, take a case where you have entered into an agreement for sale of property. You have received part consideration. You have yet to receive part consideration, and as a corollary, you have not given possession. What will be the date of transfer? If the date of transfer is 22nd July or earlier, the law or the rates and the mode of computation is distinct. From 23rd July onwards, it will be distinct. I gave the example of an immovable property because that's the easiest example to give, but the real difference is now going to be in regard to every asset. For example, take a case of shares, unlisted shares. For listed shares, it's simple. Your contract note, the day on which you sell or purchase your shares on the stock exchange, would be your date of transfer. But take a case of unlisted shares. At what point of time have you given delivery? Suppose there is a share purchase agreement and the dominion and control of the shares shifts on the basis of that agreement. What will be the date of transfer will now be a relevant factor. Therefore, my advice to you is, when you look at a transaction now for assessment year 25-26, falling within the previous year 24-25, please ensure that you have adequate documentation in place to establish the date of transfer, because unless you are able to do that, you will not be able to determine the charge of capital gains, both in terms of the computation mechanism, which has been amended, as well as the rate of tax. The next amendment is the mode of computation. The benefit of index cost of acquisition and index cost of improvement shall not be available from 23rd July 2024. Frankly speaking, I have not understood the rationale of this amendment at all. And I'll dwell upon this proposition or this amendment for a couple of minutes, because according to me, there is improper appreciation of the real concept of capital gain in the minds of the lawmakers. Why was the concept of inflation or index cost of acquisition brought on the statute book? The reason was capital gains in itself is a fiction. Actually, when you receive consideration for the transfer of a capital asset, there is no economic addition. Nonetheless, the law presumes the difference between cost and sale consideration as capital gains chargeable to tax. To mitigate hardship, inasmuch that gain consists of an element of inflation and an element of increment in value, the concept of indexation was brought in. Now, all of a sudden, you have done away with the concept of indexation, saying that we have want to bring in simplicity in the law. Frankly, I have not understood what complication ever existed in regard to the obtaining or making the indexation at all. Yes, there were some complications in as much as where the cost was incurred over a staggered period, whether one should index it from one point of time or index it as and when the consideration, rather the cost got incurred, was certainly a debate. But beyond that, there was virtually no problem at all in regard to this concept of indexation. Now, what is the implication? The implication is that because you have done away with indexation, we really do not know, and because there have been a lot of things doing the rounds as to what really will be the, shall we say, the break even or the equalizing factor in regard to the reduction of tax rates from 20 to 12.5. You can have various examples, but according to me, I would oppose the deletion of the cost inflation or the indexation part, because that was predominantly to delete from the gain the amount which pertained to inflation. That you have simply done away with. That is one factor. The second most important factor is that now, because of the absence of indexation, you will have a scenario of a larger quantum of capital gains being liable to tax, albeit at a lower rate. For example, take the case of 54. 54 mandates that you invest the capital gain earned on a residential house. 54F mandates that you invest the sale proceeds. Now, the reference now will be to a larger quantum required to be invested. So there are a lot of workings which we did in our offices. There will be different scenarios in 54F which require sale consideration and an exemption calculated with reference to capital gain, different in regard to 54. So according to me, there will be a problem in as much as a typical case illustration I will give, that a retired person wanted to settle in his life two sons. What would he have normally done? He would have sold his old house. Having sold that old house with the indexed cost of acquisition, he would have computed a capital gain. He would have been required to invest that capital gain, maybe in one or maybe in two houses, for the purpose of claiming exemption under Section 54. Now that quantum itself will undergo an increase and he will suffer a larger tax liability. Now that is something which I think we are already planning a representation from the Bombay Chartered Accountants Society, that at least qua residential houses, or for that matter qua immovable property, the concept of indexation should remain. I will quickly deal with, since on 48 we are on the mode of computation, I will quickly deal with some other scenarios or some other, shall we call, incorrect propositions of law which are doing the rounds. I'm told that a government official has said that the stamp duty and interest which is paid on acquisition will not be allowed as now a cost of acquisition. As far as interest is concerned, there was an amendment earlier to say that to the extent interest has been allowed under 24, you would not get that deduction. But I don't see any reason whatsoever for not allowing a deduction in regard to the cost itself. So the stamp duty itself. I have once again checked the amendments, and I really don't see any proposition. You can safely say that the stamp duty, registration charges, and everything else which was allowed in terms of the cost of acquisition in 48 will continue to be allowed. The next amendment is to section 55, a very small amendment that is in regard to a very specific category. You are conscious of the fact that listed companies are entitled to or even earlier, prior to the finance bill, were allowed at rather the tax at a lower rate. The requirement was that both the acquisition as well as the sale ought to have borne the the tax levied by the stock exchange. Now, the question was in regard to an offer for sale consequent to an IPO, because the initial part did not bear the transaction tax, whether the lower rate of tax would be applicable or not. At that point of time where the gains were exempt, the government had issued a notification that in such situations, the relevant provision, section 1034, if I mistake not, would still continue to apply. Now, because of the amendments to section 55, they have now provided in a scenario that in an offer for sale where the unlisted shares becomes a listed share, then the purchase price into the CII of FY 2017-18, because 2018 is the year in which the grandfathering provision comes into force. From that till the CII in the year of the asset was first held, or CII of 2001-2, whichever is later, that should that should be applied to the cost, and on the balance reducing from the sale consideration, you will have the chargeable capital gain. It's a very specific situation, but nonetheless, since this amendment has been made to 55, let me deal with it. 112A, they have called it a standard deduction. It is not a standard deduction. Long-term capital gain up to rupees 1 lakh is not chargeable to tax. That limit has now been incremented to 1,25,000. As I said, change in period of holding we have dealt with. Then the charge of tax. In the charge of tax, 111A, which was hitherto 15%, that now becomes 20%. 20% becomes 12.5, and so on and so forth. So therefore, for people who have held assets for the short term, that is in regard to listed assets, listed shares for less than 12 months, they will now bear the brunt of a larger tax. Instead of 15%, the charge will be 20%. In rest all cases, the tax will increase in from listed shares from 10 to 12.5, and for others it will reduce from 20 to 12.5. As I said, the finance minister said that this is her concept of simplification, though according to me there was absolutely no reason to really tinker with the rates at this stage, especially because she says that a DTC was on the anvil. Here I have put in this slide the note, the date of transfer will assume great significance. In fact, today morning itself, we had a client saying that I have paid stamp duty on 22nd, the agreement is ready, what will be the date of transfer? So all these issues now will gradually come up and will be debated on. As I said, for a council like me, good things, but these are situations which possibly could have been avoided. Serial numbers 1 to 6 list the various categories of, shall we say, special types of assets on which there were different tax rates. I'll not dwell too much upon that. We will be sharing this. I'll be sharing this slide with the branch. So therefore they can, share it with all of you. Then 50AA transfer of the following capital assets will give rise to short-term capital gains. That was the position in regard to market-linked debentures earlier as well. Now also there will be a position of units of specified mutual funds, market-linked debentures, unlisted bonds and unlisted debentures, etc. Their transfers after 23rd July 2024, irrespective of the holding period, will be liable to a tax rate of 20%, which is applicable for short-term capital gain. There is also an amendment qua the definition of the definition of specified mutual fund. There is an increment in regard to the equity holding, which earlier was 35%. Now it has been made 65%. This amendment, of course, will be effective from assessment year 26-27. Now there is an amendment in regard to section 47. And one may wonder as to why this amendment was brought in. This amendment was specifically brought in, shall we say, to plug what the department called a loophole. What was the wording of section 47 subclause 3 hitherto? The wording of 47(3) subclause 3 hitherto was like this, that in regard to any transfer of capital asset under a gift or a will or a irrevocable transfer was something which was applicable to all persons, including non-individuals. So what was happening was that even corporates, particularly in schemes of arrangements or schemes of family arrangements, were gifting their shares to specific shareholders or directors. Now, in fact, 47(3) never had this intent. The intent was that if the asset flowed from one to another on account of what we call an involuntary transfer or a voluntary transfer for love and affection, which was gift or a will or an irrevocable transfer, then in that scenario, it should not be treated as a transfer for the purpose of taxation as well as calculating holding period. But this to an extent was, shall we say, misused by companies by using this for the purpose of gifting in family arrangements. That has now been blocked, and from 23rd July onwards, you will have a situation where you will these will not be treated as this will be treated as transfers, and consequently we will have taxability either if there is consideration in terms of the normal taxing provisions or otherwise in terms of section 56. Provisions regarding buyback of shares. Now this again is something I see that somebody has put up a hand. What we will do is that after I complete my presentation, subject to the permission of the chairman, I will be willing to take some questions. So we'll be dealing with all the questions that you have at the end. Unless there is a problem of audio, I think I will continue. The next set of provisions is in provisions regarding buyback of shares. Now, again, why this buyback of shares has been amended, I really don't know. But according to the government, this buyback of shares was being misused. According to me, the law in terms of rewarding my shareholders afforded to me two routes. One was the dividend route, when I distributed my profits for as by way of dividend. The other route was the buyback route. So I offered to the shareholders that I'm willing to buy back your shares, subject, of course, to the company law provisions. The company law provisions are contained in section 68 of the Act 2013, Companies Act 2013. Those two routes were available, but somehow the finance minister believes that there was an element of planning in that. So now 4 sections are sought to be amended. And what are they? The exemptions qua section 1034(8), inasmuch as earlier when the company paid tax under 115 QA, the tax on buyback, the consideration received by the shareholder was not liable in a sense, logical, because in 100 QA you were already paying the tax. That section gets amended and will not operate from 23rd July. Sorry, not 23rd July. Buyback, I think, is from 1st October or 1st September. From buybacks prior to that date will be under the old law. The new law will apply from 1st October or 1st September. Now, the position is like this. So 1034A gets amended. The funniest part of it is that now they have inserted clause F in 222. In terms of 222 now, the entire payment made by a company on buyback will be treated as dividend. And remember, they don't give credit even for the cost of shares which have incurred. Obviously, when the company pays me back something, embedded in that money received is obviously the cost of the shares for which I paid. That also credit I will not get now. Again, as I said, I don't see any rationale for this, but yes, the sovereign has the right to amend the law. So she has gone ahead and amended this. Now all this will be treated as dividend. No deduction, including, as I said, the cost of the shares, will be allowed in terms of section 57, because under the mandate of 56, dividend will be taxed under the head income from other sources. No deduction will be allowed. They have specifically provided, because 46A has not been done away with. So as a corollary, they have said that consideration received by shareholder on buyback of a domestic company will be treated as nil. So 46A, they have made virtually non-operative from the date on which these amendments come into force. And the proviso to 115 QA, obviously, the company will not be liable to tax. Again, this is an amendment which I really don't understand as to why these amendments are actually made. But yes, as I said, the sovereign has every right to make amendments. She has done so. There was a feeling in some quarters that buybacks were planning modes. I really honestly do not think so, because the quantification of buyback tax was virtually equivalent to in tax that one would pay on declaration of dividend, which would be chargeable in the tax of shareholder. And what I dread is not the concept of this situation of 15 to 20 or 10 to 12.5, etc. As I said, I have always in my 40-year career dreaded the fact that when somebody says law is to be simplified, it often becomes complicated. And there is no sanctity to the amendment by way of ensuring that what is said today will continue in future. And I'll give you in a couple of minutes the classic example of taxation of dividends. When in 2003 or 4, I forget the date, when the dividend distribution tax was mooted. I was an avid, researcher at that point of time. We used to study the Finance Act, etc., in length. What did the finance minister say on the floor of the House? It was said that, look, dividend goes to lakhs and lakhs of shareholders. It becomes difficult for us to collect tax from so many shareholders. Therefore, what we are going to do is that the company at one point of time or one point collection would pay the tax, and according to us, we have arrived at the average rate of tax on dividends, which according to them was at that point of 10%. Successively over the years, tax rates came down, but the tax under 115O always went up. So it was conveniently forgotten that if you said that we have calculated the rate of tax on the basis of the average rate of tax that shareholders suffer, there was no rationale in increasing that from year to year. But they did that. I'm worried that this same thing will happen. Today, you are happy from paying 10 to 12.5. You have lost indexation. So, all right, 20 to 12.5 reduction, 10 to 12.5 increase, and all these situations you are accepting. But when you tinker with a rate on to say that you are simplifying the law, and on the ground that ultimately the income quantum suffers the same quantum of tax, I'm afraid that you are opening doors to abuse. So therefore, this is something which, as professionals and as investors or as citizens, should be really agitated about, because there is absolutely no logic. The next set of questions is next set of amendments is in regard to charitable trust. Will not dwell too much on that. You had, two sets of provisions exempting income of charitable trust. One was the classical 1023C, which exempted income at the threshold, and then it was section 11, which granted charitable trust the exemption on the basis of the income they would apply. 1023C, when it came in, was a simple section. Over a period of time that they wanted to calibrate certain situations, they kept on adding provisos. In fact, if somebody comes to my office, they will see that the number of provisos were so much in abundance that on the Taxman Income Tax Act in my cabin, I have by hand written the number of the proviso, because it becomes absolutely impossible, because when they make an amendment, they say the 17th proviso, the 18th proviso. How do you count? Because the provisos are there to the main sections and to the subsections as well. So I've literally numbered them in pencil for proper comprehension. The law was becoming complex in regard to charitable trust, and because 1023C trust also had been calibrated now in a way that more or less they were in line with the general exemption in terms of section 11. I think this is a welcome thing. So now, to quickly explain to you, you will have now two categories of trusts. One category which will enjoy exemption under 1023C, and that category will be limited to only two types. One is hospitals or institutions solely existing for education, which are wholly and substantially financed by the government, or are all small in size, which means their aggregate receipts are 5 crores or less. So it is only those charitable trusts which will continue to enjoy exemption under 1023C. Rest, 4, which was applicable to special charitable trusts or special institutions, religious places and special places, etc., and the recognized educational institutions or charitable hospitals, which was 6 and 6A. So what remains is only 1023C, 2, 3AB, 3A and 3B. So virtually, as I said, the small schools and small hospitals, as well as those which are wholly and substantially financed by government, will remain in 1023C. Rest all will now go into 11. I think this rationalization, one of the few things in this budget which I would welcome. I think this is a very welcome provision, and I laud the finance minister for this. 12A, as I said, 4, 5, 6 now go in accordance with 11. They have now given an extension to charitable trusts for filing applications for registration. The registration process was, made so complicated on account of the various clauses in 12A1AC that one was often confused as to which clause will apply. So what they have now done is, hitherto, that is, you had a number of CBDT circulars, first extending the date to September 2023, then extending to 30th June 2024. Now what they have done is, in regard to all applications which are belated, they have given the power to the commissioner to condone the delay if it is for a reasonable cause. I think this is a welcome provision. It needed to come in much earlier. This is as far as 12A, 12AB is concerned. This again pertains to procedure. It defines the time frame, 3 months and 6 months, etc., within which the orders in terms of registration under section 12AB are to be passed. The only problem that I have here is that when the time limits are mandated, I have often said that the problem is not with the law, the problem is with the administrators of the law. We have a number of cases where a trust applies for registration, and at a point of time that the time limit is about to expire, you have the administering officials simply rejecting your application on some reason or other. Yes, is there a problem in hearing?
Nice, sir.
So this is as far as 12AB is concerned. 12AC addresses the merger situation. Merger situation in terms of when you are now having a situation of 1023C and 11 getting merged, the situation is that can a 1023C trust be merged with an 11 trust? They have now provided by way of a specific provision in 12AC that if you have the same or similar objects, two trusts can merge, and the provisions of accreted tax, that dreaded chapter 12EB, will not apply. And I think this is again a very welcome provision, because you really do need a provision where somebody wants to exit the charitable section provisions by way of letting go of a charitable trust in favor of somebody else who is actually having similar objects. One should definitely permit the same. Section 13, there is an amendment in section 13(1)(d). I don't need to dwell upon it. It's only a question of calibrating the provision as far as certain class of assets go. Provisions regarding ATG, here there is a small issue, in as much as what has happened is that they have in the memorandum or explaining objects said that this period for the obtaining the renewal of ATG will be extended, but that same provision has inadvertently remained in the bill. I reckon that when the amendments come through, that also will be amended. Next, you have amendments to withholding tax provisions TDS and TCS. In the interim finance bill, there were significant amendments to TCS. Now you have amendments to TDS also. Here again, I believe that some of the amendments were, required or, but some of them are virtually tinkering. The first amendment I'm dealing with is section 194I. Here again, and as I said, one really needs to understand the thought process. 194IA is that 1% deduction, which is a 1% tax deduction, which a purchaser or a transferee of a immovable property has to make when he acquires property in making payments to the seller. The limit of the threshold of application was 50 lakhs, and a debate was there as to whether it would apply property, qua property, or qua owner, number of owners. Now they have gone ahead and said that yes, it would apply qua property. If I recall correctly, in fact, there was a circular issued by the CBDT saying that it should be treated qua owner, obviously qua beneficial owner. So earlier the stand that the revenue took was that this limit of 50 lakhs qua a defined share in property should be qua owner. So if you have a defined share in property of say 50% and the property is 75 lakhs, the consideration payable is 75 lakhs. Earlier, the provision, the position accepted by the revenue was that no withholding tax of 1% would be required. Now they have gone back on that and they have said that no, now it is qua property. And I'll tell you the reason also why. The reason is that, and this is something I'll share not coming out of the finance bill, but coming across by way of the various interactions that we have been having with the lawmakers. The thinking is that voluntary compliance has to be encouraged, and therefore you will see in the near future your TIS and AIS expanding in scope, as if the expansion is not enough already. And the problems, I'm conscious of the problems which are galore on account of that AIS, the incorrect entries therein. But the thinking in North and South Block is that ultimately we should come to a scenario where everything should be correlated with AIS. So where you had a number of co-owners and their share qua co-owner was less than 50 lakhs, it was being not reported. Now this reporting mechanism will increase in as much as now this reporting will be required in regard to the property part of it. So according to me, this is only to because 1% was not actually collection of tax. It was for reporting purposes. They want to increase reporting. So therefore, this 50 lakhs is now property. 193, there earlier the position was that in regard to bonds, certain categories of bonds, which fell for TDS provisions under section 193, you did not have to withhold tax. Now they have done away with that, and now on floating rate tag bonds also, you are required to withhold tax. One need not have much quarrel on that because the interest in any case is not exempt. So therefore, even if it is reported through the TIS and 26A's mechanism, one really need not have much debate about it. Time limit to file correction statement in respect of TDS and TCS statements. This, according to me, is, shall we say, a real rationalization provision. Today, a TDS and TCS statement can be corrected for any number of years. So theoretically, from the time that you started filing TDS statements under section 200, you can correct that statement even today. Well, they have now said that you cannot correct it beyond 6 years, because as we shall go further, we can see that the reopening period they have now restricted to virtually restricted to 6 years. So according to me, if there is any correction, taxpayers need to be vigilant enough, in as much as they may be wanting to request a deductor to correct his statement. And therefore, according to me, this limit of 4 years is shall we say, a welcome limit. One need not have too much of quarrel with it. Reduction in the extended period allowed for TDS and TCS statements. This again is in 271H, you had a period of 1 year before which the penalty became applicable. They have now reduced it to 1 month. This is a welcome provision, because the point is that the 26 AS capturing was happening with a significant amount of delay. 26 AS needs to be a reasonably defined and static statement by the time your due date of return, which is today 31st July, comes in. So therefore, they have reduced this period to ensure that deductors now file their TDS statements in time. And therefore, this amendment, I think as professionals, we need not quarrel about. This again is something which is, as I said, some amendments, give you more work. What is the amendment? The amendment is that for all, thought processes, the lawmakers think that 194J has got two tax rates of deduction, 2% and 10%. It is their belief that certain work which properly should have been defined or should properly fall within the ambit of professional fees was falling under 194C, and therefore a lower rate of tax was being withheld. Now that goes, and they have specifically said that 194C defines work, and therefore it is now proposed to explicitly state that any sum referred to in subsection 1 of 194J shall not constitute work, and therefore obviously will now suffer a higher rate of tax. Again, it's tinkering with the law. You will then have disputes coming in, which according to me, what the lawmakers must appreciate and understand is a withholding tax provision is not a charging provision. It is a collection provision. So therefore, it is needed to make it as simple as possible. We have in the Bombay Chartered Accountant Society for 20 years advocated that with the technology now, especially now, the technology being available, what you should do is you should simply have a passbook scheme for TDS. All my tax deducted should now form part of a credit to my passbook, and I should be entitled to use that tax credit in any manner or in any year that I desire. This will reduce the problem significantly of the disputes we have in regard to rate, in regard to year in which you should get credit, and so on and so forth. So according to me, some out of the box thinking is necessary here. Now there is a tabulation in regard to change in rates. I don't think I'll read it because all of you can refer to it when this particular PPT is circulated. 196B, 196C, again applying to certain specific situations like global depository receipts and 115 AC GDR bonds, etc. Will not dwell upon it at any degree of length. Again, scheduled part 2 rate of deduction of taxes in company. Now that foreign company rate they have reduced from 40 to 35%. So as a corollary, in certain rates which were for foreign companies 40% has been brought down to now 35%. This is provisions of prosecution, because the belief of the government, and not wrong, was that qua TDS, when a person withholds tax and does not pay it to the credit of the central government, he is committing a crime and there is rationale in it. Because it's like saying that instead of paying my supplier, my customer, my supplier, my service provider, etc., I am not paying him, nor am I paying the treasury. So therefore, what they have done now is that, and therefore prosecutions used to be launched in some cases in regard to very small delays also. So now what they are saying is that if you have not paid the tax, but have paid it up to your due date of filing the TDS statement, then you will not be prosecuted. I would only suggest that if they want to make this provision and their intent of decriminalization of the law more effective, what they should be doing is that they should actually be increasing this to the time when the return of income by the deductor is filed. Because practically what happens is that in most cases, one comes to know of the default only at the point of time that an audit is carried out, particularly in the case of small or medium SSCs. So therefore, extend this period as you used to do in 40A, 1A and 43B to the due date of the return. And then according to me, it will really serve the purpose. TCS on goods, notified goods under 1F, again, one cannot complain. With the intent of tracking expenses on luxury goods, and in order to widen the provision, it is proposed to be amended to also include sale of goods as may be notified. They have taken the power to notify. We recently had one of the, uh, well documented and well visualized marriages of maybe the century. And we were looking at a large number of gifts. Now, therefore, if TCS is to be paid on such gifts, well, one need not have much quarrel on that. Because yes, if there are luxury goods, I only feel that they should keep the limits reasonably high so that it does not becoming a dampener. Provisions impacting firms, and this is again something which will affect all of us. The first amendment is in regard to the amount of allowable remuneration, which they have liberalized. The earlier slab was 3 lakhs, 1 lakh 50 or 90%. Now that gets to 6 lakhs, 3 lakhs or 90%. Huh? Oh, want me to take this out? आत्ताच थांबला? I will check whether I'm audible now. I think my juniors are telling me that my voice was not audible.
No, no,
No, it is audible.
audible.
It's audible.
Audible.
It is audible now, na?
Yes, yes,
No,
sir.
Yeah.
You can continue, sir.
There must be some problem at their end. No problem, no problem. I was dealing with the provision impacting firms. And as I said, this is a provision where, sorry, we'll go back to the first slide. So here, what they have done is that they have changed the slab. So now a higher quantum of remuneration will be allowable. In fact, when I used to, the taxation of firms is dear to my heart, because when I spoke for the first time in 1993, it was full screen. Okay, okay. Okay. When I spoke for the first time in 1993, it was in regard to taxation of firms, because it was at that point of time that the law changed. those of you who are young are simply unaware of the concept of something like registered firms. So again, coming back to the topic, this quantification has been changed. And I've said in my last line in my slide that firms may have to consider amending partnership deeds, because I've seen a large number of partnership deeds providing that the quantum which is allowable. So they at times they refer only to the Income Tax Act, in which case possibly one will be able to argue, because I don't have time to take you to the concept of uh, you know making an amendment by incorporation or separate legislation, in the sense that if you refer to a particular provision of law as it stood at a particular point of time, then despite the fact that the provision may be amended, the provision in the partnership deed does not change. But if you draft it differently, then if the provision gets changed, then your allowable remuneration also will undergo change. But please consider whether a change in your document is necessary or not, for the simple reason that for the purpose, and everybody considered section 40 subclause B as a provision allowing a deduction, which it is not. The deduction is to be allowed under section 37. 40 subclause B merely limits the allowance. Therefore, just consider as to whether you are fulfilling the norm of the deed authorizing and the remuneration being is authorized and is in accordance with the partnership deed, because only in that case it will be allowed as a deduction. 194T is in as much as they are now providing a 10% withholding on remuneration, and this is likely to create a fair amount of problem. The reason is there will be a twofold problem. One is that your profit, because the allowable remuneration quantum is determined on the basis of a book profit, which will get determined at the end of the year. However, you will be withdrawing from time to time the amount of monies from the firm. Now, in that situation, unless you are able to calibrate those withdrawals being equivalent to or close to equivalent to your remuneration allowable, you may have a problem of a excess TDS. And I'm not worried about the excess TDS also. What I'm more worried about is that on the basis of your deduction, this will be reported in your 26AS. Once it is reported in 26AS, should the remuneration that you submit to tax as a partner of a firm be lower, then you will be possibly questioned as to how you are going to reconcile this. So here you have to be extremely careful. The problem can possibly be resolved in case where there is a large quantum of capital lying in the credit of the partners. There you can possibly provide that the withdrawal during the year should be treated as withdrawals of capital, and in which case, of course, or withdrawals of share of profit, in which case, of course, the TDS provision will not apply. But that again, one has to look at from case to case basis. But otherwise, this withholding is really going to create some heartburn, particularly in the context of professional firms which have a cash method of accounting. So this is somewhere where you will have a problem. Of course, one will have to live with it. Again, as I said, a 10% withholding should not be a major problem, because all of us, I presume, would be paying a much higher tax. But nonetheless, this is something which can be sort of, represented on two, or the representation can be drafted against this on two grounds. Number one is that remuneration in effect is not actual remuneration for or is not a recompense only for work done by a partner. The Supreme Court, way back in, I think, 101 ITR, has recognized the fact that remuneration is a special share of profit. And that is precisely why in 28 subclause 5, you have a provision that to the extent that remuneration is not allowed, it will not be taxed. So remuneration is not something which is akin to a payment of professional fees. So to my mind, it is on a different footing and one need not have provided for a TDS, but it has come because the view of the department is that many partners, and this again is something which we need to be careful about. Many a time what was happening is that either partners were not filing their returns, or if they were filing their returns, they were submitting their incomes to tax under section 44 AD or in regard to professional firms under 44 ADA. For whether in the case of business firms 44 AD can apply to remuneration, I don't think so. Even in the case of 44 ADA, there can be an element of debate. So according to me, it is for this reason that this TDS has come in and we'll have to live with it. As I said, the issues that will arise is cash basis of accounting when the point of time needs to be determined, and when if only it is credited to your account when you make a provision. All these issues will arise because the withholding is payment or credit, whichever is earlier. So this is a, shall we say, a problem area. Then we can come into the rationalization provisions. In the rationalization provisions, what they have done is they have amended the TDS and credit of all TCS and TDS paid should be allowed while the amount of tax deducted on salary income of employees welcome. Because today also you are entitled to submit a statement to the employer and he'll have to consider both the income and the TDS. This TCS situation has come in because earlier that TCS was not allowed, is that many salaried employees also now send their awards abroad for education, and there is an element of TCS. It is in order to take care of that situation that now this particular provision has been brought in. So no quarrel with that. Time limit for filing an appeal, what they have done is that they have extended this time to 60 days from the end of the month within which this particular order was received by the commissioner. Again, according to me, it's only rationalization with which we really ought not to be concerned. Provisions regarding to set off and withholding of refunds. This is something I said all through, and we have been saying this repeatedly, that in each finance bill, there is virtually no element of introducing any accountability. Here also, they have now specifically provided that you are where there is a tax which is a liability which is likely to arise imminent, then you can withhold your refund, and the interest that they pay would start after an extended period. This is a provision which one should really be agitated about, because if they charge interest, on the taxes paid by you with some delay, then if they withhold the refund which is legally due to you, then also they should pay according to be the same rate. In any case, in my 40-year career, virtually a payment of interest without any application, etc., is hardly available. Most of the time, there is no interest ever paid. The omission of angel tax provision. Now, this, according to me, I'll just sound a warning bell in this connection. The reason is, when we were discussing this in various fora, first of all, the section itself is not angel tax. It is actually a share premium which cannot be justified, that is taxed in the hands of the company. And why did this provision come in? There is a history to this. The history is that companies, which I dare say there is a concept or there is a phrase called shell companies. Those companies were used as a conduit for money laundering. You used to have shares being issued at obscene premiums, and then that money being laundered. They could have very well calibrated 5627B. They have not done that. They have deleted 5627B, which effectively means that now onwards, if a company receives consideration for shares much in excess of its face value, then it will not be liable to tax under 5627B at all. It could obviously not be taxed in the hands of a company under 56.210, because it is not property that it is receiving, it is only money that it receives. So therefore 56.210 is a non-starter. 56.27B also will not be attracted. I must only sound one warning bell to all the participants, is that section 68 is not done away with, which means that the creditworthiness of the person to whom shares are allotted still has to be established. And section 68 has to an extent now been strengthened in the past. So please ensure that while yes, 56.7B will no longer be a part of the statute book, it will now 68 is the only thing that you will be using. And of course, if the amounts received or amounts quantums involved are large, then you have GARB could be invoked. I must mention here, because I often get cases where people quantify and say that because 3 crores is not the tax impact, GARB will not apply. Let me warn you that GARB only sets out only a threshold limit and nothing more. So therefore, McDowell's, though watered down subsequently, is still a part of good law. So therefore, please don't go overboard in advising your clients to issue shares at premium. Then the next amendment is in regard to reintroduction of block scheme. Here again, I don't know why they really brought it in. Because see, from block assessments, you travel to assessments in the normal course, which according to me was quite reasonable. One need not have really worried or bothered about this. But yes, this is what they have brought in. So now, in regard to searches that take place from 1st September 2024 onwards, instead of an year-wise assessment, you will have a block assessment. According to me, this is something which really need not have been brought in, but so much so for their wisdom. Now, from searches from 1st September 2024 will attract the block provisions. Time limits for reassessments, that has been now calibrated. You have from 2021 till now, the law has traveled significantly in terms of reassessments. And according to me, now rather than normal assessments, reassessments will be the norm, because it is only on the basis of information either on their portal or received otherwise is that assessments will take place, and those assessments would normally be reassessments. So I would believe that in future your scrutiny assessments would be possibly a minuscule percentage, and there will be a much larger assessment. What they have done is that they have calibrated it now. If it is on their if the reassessment is on something on account of their Insight portal, the period is only 3 assessment years, and the period for issuing 3 years from the end of the assessment year, and the period for issuing that notice under 148 capital A is 3 years and 3 months. The only shall we say bad part of this is that they have now, earlier in terms of section 148, the term used was service of notice. Now it's been calibrated to issue of notice. So the issues which were there earlier as to what constitutes issue of notice, etc., will now once again raise their head. As I said, 148A, no notice shall be issued if 3 years have elapsed from the end of the year, unless it falls under B. And if 3 years but not more than 5 years have elapsed from the end of the assessment year, unless income chargeable to tax, which is escaped assessment, for which the information is with the assessing owner, amounts to or is likely to amount to 50 lakhs or more. This, according to me, is important because the issue was earlier, the position was that there was some degree of debate in the interim period. In the first, you had the 50 lakh limit applied qua year. Then the amendments from 2022, whether the 50 lakh limit applied to the entire period of 5 or 6 years was being mooted. Now again, they have come back to 50 lakhs per year, which to my mind is a very reasonable thing. The only point, as I said, is now they have replaced the word served on the SSC to issued. This, as I said, will have its own repercussions. Sanctioned by specified authority, one need not really get into. Then the next provision is 153. 153, again, according to me, not very significant. The time limits have been, shall we say, slightly calibrated. Nothing to discuss on this. The direct tax Vivad Se Vishwas scheme 2024. In 2020, you had a scheme which met with reasonable success, not as successful as the earliest VDS scheme, but with reasonable success. Apparently, for those who have missed the bus at that point of time, today also, you can go in for VSV, as they call it. And what is that VSV now? Now the scheme, which will now be notified, the rules, etc., will be notified later. The scheme divides pending disputes between two categories and two periods. One is disputes in respect of tax, dispute in respect of interest, penalty, and fees, and whether the disputes arose prior to 31st January 2020 or after 31st January 2020, which means that this is a tacit admission that the disputes which arose prior to 2020 are still pending resolution even at the CIT appeal stage, forget tribunal or the High Court, and of course post 2020. So if your dispute is pending in any of those periods and a dispute is pending as on 22nd July 2024, then you pay either 100 or 110% of the tax or 25% or 30% of the interest, depending on when your dispute arose. An incremental amount of tax is paid and penalty interest is payable. The tax, penalty, and interest is payable if you pay it after December 2024. Some incremental tax and interest or penalty is payable. I think otherwise the scheme is, shall we say, as or a paramateria with what 2020 was, save and except one distinction. In the old scheme, if an assessment had been framed or an order had been passed, so no dispute was pending, but the time limit within which you could file an appeal or raise a dispute had not expired, still you fell within the definition of appellant and specified person. That provision does not seem to be there in this Vivad Se Vishwas, which means that if you have not filed appeal before any forum at all prior to 22nd July 2024, then you cannot avail of the Vivad Se Vishwas scheme 2024. Other provisions are, we'll quickly go through them. because I'm coming to the close of my time. Treatment from letting out of house property. I have deliberately not covered some provisions like cruise ship, etc., because they do not really interest most of the audience. Treatment of income from letting out of house property. An explanation is now proposed to be inserted, whereby any letting out would be chargeable to tax under the income from house property. What was happening was that because we went into the history of why this came in, the history was that there are a large number of individuals letting out their properties as service apartments. And what they were doing was that they were wanting, because the actual rendering of service is done by the persons who provide the service like laundry, food, cleaning, etc., etc. The actual owner is actually only letting out premises. Therefore, and then the owner was claiming expenses under various heads. In order to take care of that proposition now, they have introduced that it will now be taxed under the head income from house property alone. Yeah, equalization levy, which was there was equalization levy and 194O, and the duplicity or the double, shall we say, whammy was creating quite a heartburn. Now, from the 1st August 2024, equalization levy, which came in like service tax by a finance act, now is sought to be done away with, and therefore we will be now without equalization levy, because the finance minister says that they are getting into some arrangements with a lot of countries, and therefore equalization levy was point which was being disputed, and therefore they are doing away with this. This is interesting. Power of the commissioner appeals. Currently, the commissioner appeals does not have the power to set aside an assessment. So, in terms of section 251, a commissioner appeals either allows your appeal, dismisses your appeal, but even if you produce additional evidence at the time of appeal, or he feels that the assessment has been framed very unjustly and without considering the material on record, or you have not been able to provide the material on record, even assessment is framed under section 144, the CIT appeals does not have any power to to set aside the assessment. Now, by virtue of this particular amendment, that power is being taken by the CIT appeals. If there is a base judgment assessment, he can set aside the assessment to the assessing officer. Now, we were thinking as to whether this is a good thing or a bad thing. And some of my colleagues in the Bombay Chartered Accountants Society felt that this was a way of reducing litigation, because you are all aware that close to 5-6 lakh appeals are pending at the first appeal stage. So there, where the assessments are framed under section 144 and you have made submissions, and the CIT appeals feels that it is not possible for him to consider the additional evidence on its own, and therefore he currently the only option he would be having is to set aside to remand this matter to the AO for a report. He can now set aside the assessment. This is the shall we say, the logical thing. But what is the effect? There is another effect to this, is that if the assessment, because the law says is that he is entitled to send it or set aside the assessment for making a fresh assessment, which effectively means that in an assessment framed under section 144, if a significant quantum of demand has arisen, then if that assessment is set aside, the demand itself will get nullified. So that is a plus. Again, you will be relegated to the level of the assessing officer is a minus. you really have to take your choice. These are amendments which are not of great relevance to us, but nonetheless, in the interest of completeness, I have put them in here. There is an amendment to Section 24 of the Benami Prohibitions Act, where they are saying that if you are called upon to make an explanation, to give an explanation as to why you should not be treated as Benamidar, there was a lacuna in the law that it did not precisely provide for the time frame within which you had to file a reply. That has now been brought in. Then you have an amendment in Section 55A. Section 55A, again, a particular Benami transaction is punishable with a penalty of rigorous imprisonment for a minimum of 1 year or number of years, along with fine extending to 25%. So, with a view to obtaining evidence of Benamidar or any other person referred to in that section, 55 has been inserted, which provides that the IO, that is the investigating officer, may tender to such person an immunity from penalty for an offense under Section 53, subject to the condition that the person makes a full and for. So virtually what they are saying is that in a proceeding under this act, if you make a full and complete disclosure and to say that, yes, you are the real owner of a property which is held in the name of a Benamidar, then you may escape prosecution. They have only used the word tendering an immunity. Possibly wrong usage. It should be grant of immunity. This is 55A. Then there are two amendments to Section 42 and 43 of the Act. You are all aware that if you are a resident, you have now to declare all foreign assets in your return of income. And the penalty for a non-disclosure is as high as 10 lakhs. There are certain exceptions provided in as much as that if you have a bank balance of a particular quantum, then the penalty will not apply. What they have now sought is to say that if the value of the asset, and now this in itself, as I said, every amendment seeking to simplify the law complicates the law, and I'll just illustrate it by this amendment. What have they said? That if the value of the asset, which is not disclosed, is 20 lakhs or more, is up to 20 lakhs, then you will not be liable to pay a penalty of 10 lakhs. What is required to be reported by you in the reporting is the cost of the asset. Now, therefore, for the purposes of the disclosure, you disclose the cost of the asset. But for determining whether the failure to disclose or not is liable to a penalty or not, then that is, you have to ascertain the value, and if the value of that asset is 20 lakhs or cess, then you will not be visited with a penalty of 40 to 43. So now a fresh dispute, and why I'm saying this dispute will arise, because the quantum of penalty is very large. But remember, friends, that this is something where you all need to be careful, because many Indians who were abroad return, they have foreign assets abroad. They do not disclose those assets, which at the point of time of their acquisition would have had a small quantum of, they may have incurred a small quantum of cost. But now those assets have significant value. So please be sure that you report that, because now on account of the exchange of information, you will find a lot of proceedings emanating in the near future in this regard. So please be careful in regard to particularly returning Indians who have become residents under the domestic law now, so that they declare that income properly. Section 231A, this is only a, shall we say, theoretical. What the provision is that if there is a due under the Black Money Act, that also is now to be included for the purpose of obtaining a clearance certificate by a person. So if you have arrears, then you require to obtain a certificate under Section 231A. It is virtually followed in breach. I have never come across an immigration officer at the airport calling for this certificate, but maybe now they plan to do this, because I really don't know the reporting mechanism in this particular regard as to how this information flows from the department to the immigration officer. This is as far as the amendment BMA goes. 132B1, again, a liability has to be reported. That's about all. I think I've exceeded my time for around 10 minutes. Let me leave enough time for Omkar, who is to follow. And if time permits, if Mangesh and the others feel, I'm willing to take a few questions if people have any. Thank you for a very patient hearing. Yeah, any questions? Mangesh?
I think Mr. Dharmesh Shah has raised his hand. Dharmesh ji, do you have any question?
Sir, we can definitely take 4-5 questions. So, if anybody has any questions, please feel free to ask so that the sir can address those.
Yes, Mr. Mangesh Kulkarni, you have a question. Please unmute yourself.
Sir, can you please elaborate on grandfathering provisions for capital gains of properties before 1st April 2001?
Grandfathering provisions would continue, in the sense there are two normal grandfathering provisions under the capital gains chapter. One is in regard to that 2018 in regard to listed shares. As far as the grandfathering provision, as far as 2001 is concerned, the fair market value, which after 2018 is the ready reckoner value of immoral property is concerned, those grandfathering provisions continue. In fact, there is apparently a misunderstanding in the mind of both the bureaucrats and the FM, because she said that when grandfather, in the sense 2001 fair market value you will get. In fact, grandfathering is a totally different concept from indexation. So therefore, grandfathering is today also available. Is there any issue, doubt in that regard?
For example, if a property is purchased in 1990, say, then how it will stand as far as indexation is concerned? Because they have done away with the indexation.
Your voice is not very clear.
For example, a property purchased in 1990, what will be the position about indexation, since they have done away with the indexation provision?
See, the indexation provision will come into play when you sell. So if you have acquired the property in 1990, which is prior to 2001, obviously you will be entitled to the substitution of the fair market value or the ready reckoner rate as of 2001. Does not seem to be any doubt on that. So grandfathering provisions have not been disturbed by the finance minister. Those will continue. So 2001 FMV you will not only get indexation. That is what is going to happen.
Okay, so post 1st April 2001, there will not be any indexation available.
I am not able to hear clearly. Anyway, if you so desire, my email ID must be with Mangesh. You can email the query. I will answer it. Not very, your voice is breaking, not very clear. I'm sorry, this rains made a havoc. I would have loved to be in Thane. And let me give a promise, is that if you so desire, maybe on some other subject, because I had made this a part of an annual ritual to come to Thane every year. Unfortunately, the rains did not permit me to be with you this year. So if you are willing to tolerate me at any later point of time, on a different subject, I'll be willing to come. Yes, I think.
Yes, sir. Sir, we will also love to have you soon. In one of our programs. So definitely we'll keep this in mind and we'll meet soon, sir.
No, somehow I'm sorry, I'm not able to hear you clearly. I hope you were able to hear me with some degree of clarity.
Yes, am I audible, sir?
I think Mangesh, we'll have to call it a day right now, at least as far as my session is concerned. You can ask Omkar to, because I'm
Omkar,
not
Atharva,
getting.
Yes,
And
I'm here.
as I said,
Atharva.
Yes, I'm here.
any queries you can mail to me. I will answer them.
Sure,
Yes.
sure, sure, sir, sure, sir.
Okay.
Atharva, you can please take over.
Yeah, yeah. Thank you, Sathe sir, for a wonderful session. On behalf of Thane branch of ICI, I would like to extend our sincere gratitude to you for your insightful and informative lecture. Sir has not only shared his expertise but also provided us with a comprehensive understanding of the implications of the latest updates. His presentation and the clarity in which he has given, which he has explained today, it has truly enriched our understanding in this area. Once again, thank you, sir, for taking time to be with us and sharing your valuable insights. Your expertise has undoubtedly broadened our perspectives, and we look forward to more such sessions in the future. And we are definitely looking forward to have an offline session with you in Thane. So thank you once again, sir. Thank you so much. We would
Thank you, Mangesh and Atharva.
Thank you, sir.
For your kind words.
Thank you, sir.
Thank you, sir. We'll be moving forward to our second speaker. Our second speaker is CA Omkar Garge. He is a CA and MCOM by qualification. He was selected. He is in practice for the past 7 years. He has been working in the areas of indirect taxation and is the proprietor of Messrs. Garge AS and Associates, Chartered Accountants. And he's also senior consultant with Messrs. Taxwise Advisory Services Private Limited and consulting partner with Messrs. Karvi & Co. Chartered Accountants. Before his practice, he has worked with KPMG Mumbai as a manager of indirect taxation and also with Gokhale & Sathe Chartered Accountants as a senior manager of indirect taxes. He has been a GST consultant for small, medium, and MNC entities and has worked in manufacturing, pharma, hospitals, and aviation sector. He has conducted seminars on GST, excise, and service tax for members, students, and at various programs organized by IDT Committee of ICI and study circles. He has recently authored his debut book on goods and service tax laws named GST Concepts to the Core. He has been a branch committee member at Thane branch of WRC for the term 2025 and is currently also the vice chairman for the year 24-25. So I request C. Omkar to kindly take up the session.
Yes, very good evening, all of you, and thank you, Atharva, for the kind introduction. Am I audible well?
Yes, Omkar, you can continue.
Very good evening, friends. So yeah, definitely I can say that it is unfortunate that we have to schedule a budget-related seminar on in a virtual mode, and so it gives me a bit of a memory lane that 4 years down the line, like back 4 years back, during the COVID second wave or prior to that, we did have a similar kind of an arrangement for the budget seminars. And again, this year we are on the same lines, but because of the rains, thankfully not because of COVID. Yesterday, the post the budget. In fact, during the budget, if you have heard the speech of Honorable Finance Minister during the budget, the most funny factor was that about GST, I believe she spoke only, say, for some 40-45 seconds or so, that, okay, GST, I come to the GST part. We are focusing on simplifying and rationalizing the tax rates and simplifying the procedures. And beyond that, there was nothing in the budget about GST. And therefore, myself and of course, Swapnil, who is going to follow me for the next part of this, we had a slight of an apprehension, like, okay, what are we going to speak tomorrow? But just half an hour after that, when the budget bill was issued, the finance bill was issued, we understood that, okay, there is a huge set of a variety of amendments which have been actually brought in. And then the intricacies to that, we started reading and we tried to prepare this presentation and come before you. So on these lines, we will start our discussion on the tax proposal under indirect taxes. Because we are two of us speakers, myself and Swapnil, we have categorically divided the session into two parts. Right from the provisions of summons and litigation, it will be Swapnil Kolte who will be taking it up, as it is his core area of work, core area of expertise. To be very honest, he has been representing a lot in the tribunals and also assisting in the High Court. On the other side, parallel litigation and advisory related sections and the provisions that I would be taking it up right now. So we begin with our discussion on these lines. So wherever there are any doubts, please feel free to use the raise hand mechanisms in Zoom. We can get the doubts solved at that point in time only if I am able to do so in first place. Now, the very first provision that we are going to discuss is about the most awaited change which was there. I mean, the most awaited one, which was about section 16, subsection 4, and the issues relating there. So what has been happening on this is that a lot of cases, and I'm very sure that all of you who are there right now, you must be having clients who in the initial years of GST failed to do the compliance of GST in time. They failed to file their returns in time, and most importantly, they missed out on claiming the credit within the due dates which are allowed under the law. That is by 30th day of November, which is now the due date. At that time, it was the due date for the return for the month of September following the end of the financial year. Because of this provision, what had happened is that there were a huge set of people who were having a threat of their input tax credit to be denied permanently. That means in a lot of cases, the notices have been issued already. They might be already under appeal, where the only fault on the end of the taxpayer was that the returns were filed, credits claimed, taxes paid, everything has been there, just because their credit was not claimed within the due date which was laid down in the law. Then the credit was being denied through the notices, and because of which they had a lurking issue of recovery of tax along with interest and penalty. Now, in the 53rd council meeting, which was held on 22nd of June 2024, this issue was first time addressed very properly, and it was mentioned that there will be something done to do away with this pending provision, the pending litigation issues with respect to section 16(4). Now, mainly the expectation was that immediately there was some notification to be issued, but aisa nahi hua. We unfortunately had to wait, and now we have a insertion in the law by way of a provision under section 16 subsection 5, which says so that if under section 16 subsection 5, wherein the relief for the time limit for claiming credit has been given, but please remember it is sort of only a one-time relief. It's not really an amnesty scheme, to be very honest, but it is more like a section. I mean, it is more in the nature of a section actually which has been introduced, and therefore this section is going to have a lot of gravity. So just for the sake of clarity, I am first putting up the provision which has been put in the bill. So it reads as, notwithstanding anything contained in the subsection 4 in respect of an invoice or a debit note for supply of goods or services or both pertaining to financial year 1718 onwards up to 2021, the registered person shall be entitled to claim the input tax credit in any return under section 39 which is filed by 30th day of November 2021. Now, because I know it's a bit long provision to read, so we'll just see the concise portion of it, what exactly it means. So the proposed provision is now saying that for the financial year 2017-18 up to 2020-21, means 1st July 2017 से लेके 31st March 2021 तक, any invoice or debit note which were received by you as a taxpayer, which were received by your client as a taxpayer, for those invoices and debit notes, if they want to claim a credit, and if they have done so, see, there is nothing that can be done now. If this is all historic, if they have done so by filing a GSTR 3B return, up to for any tax period by 30th of November 2021, means मान के चलो that 1718 का return delay हो गया था. Instead of 1718 credit, the last date for availing credit for 1718 technically was 20th of April 2020. I beg your pardon, 20th of April 2019. For the last day of claiming credit, only exceptionally for 17-18 was extended up to 20th of April 2019. Then for 18-19, it was 20th of October 2019. For 19-20, it was 20th of October 2020, and so on up to the last day. What they have said now, if you have filed the GSTR 3B returns by 30th day of November 2021, and which is able to encapsulate your input tax credits for any period from 1st July 2017 to 31st March 2021, then for all such invoices and in debit notes, you will be allowed to claim the input tax credit in the scenario that your ITC is being claimed through any of the returns filed by 30th of November 2021. This is a massive relief, especially MSME and SME category of taxpayers, or the small taxpayers, I would say, were the worst hit by this issue, and they are going to have a relief. Now, the only flip side to this is, now in the there was one recently a judgment was issued. I think it was in the case of Ankit Kumar Agarwal. It's a case in the Red Court of, I think, Calcutta, wherein it was supported, a view was supported that if the input tax credit claim through the annual return has been mentioned and the invoices and the documents are also in place, then the input tax credit should be permitted to be claimed by that taxpayer. Now, this is the judgment pronounced in case of Ankit Kumar Agarwal. Now, if we see the section 16(5) also, which has been inserted, that is also coming with a rider that the credit claim should be through provision, I mean, through a return filed under section 39. Matlab, it is a credit claim through GSTR 3B return only. There is no other via media which is being allowed to make the credit valid, which has been taken directly through the annual returns. The problem is that in annual return, if you only mention the input tax credit, which you probably had missed during the year, annual return form does not have any link to your electronic credit ledger. The only way in which the ITC can be going in your electronic credit ledger is GSTR 3B returns. So now there are some judgments which are coming in this nature, and if the provision and the lawmakers' insistence rather is that the credit claim should be through the 3B returns, there is some potential conflict which can also occur if such kind of judgments are coming, and let's suppose that they go further and they are getting challenged further, then we need to be really careful about them, or rather I would say hopeful. If in some of your clients' case, let's say that they have not claimed the credit in 3B, they have missed to claim the credit in 3B at all, but they have somehow claimed it in the annual returns. That is not getting taken care of by this amendment. Only those taxpayers who filed their GSTR 3B return and who captured the data, let's say on a belated basis, but before this cutoff date, their ITCs are now safe. Right? So I hope this portion is clear. Anybody has any questions with regard to the 16 subsection 5? Okay, so I'm presuming there are no immediate questions. I move to the next provision. Now there is another section which is proposed to be inserted in section 16, that is section 16 subsection 6, which is about claim of credit in case of registration cancel scenarios. Okay, claim of credit in case of registration cancelled scenarios. Now let's take this up very specifically, that this section 16 subsection 6 has got nothing to do about that 2017 se leke 21 tak ka period. No, this is completely a new provision which is being made or proposed to be made in the, proposed to be brought in the law for any circumstances arising in case of a taxpayer, whose registration is getting cancelled, and subsequently the revocation of cancellation takes place and the registration gets restored. I am repeating, this provision is not for the past issues, etc. This is purely a provision which is going to be inserted for what scenarios? That in a normal running business, let's say for default of filing returns or for any other reason, the registration of a taxpayer is cancelled. Thereafter, he applies for revocation of registration. the revocation is successfully done. And for such taxpayer, how about the timeline of claiming credit? Because often it would happen that uska registration restore hone mein, it used to take say 5 months, 6 months, 7 months. He used to miss the bus for claiming credit because अपना section 16(4) का timeline निकल जाता था. In such scenarios, how the tax credit can be claimed and retained, that is what we are now going to discuss. Now, what this provision particularly has to say is that if there is any cancellation of registration, and there is a subsequent revocation of the registration, the revocation of the cancellation, in such a case, how the eligibility of credit is going to be defined. So just for the sake of it, we'll just take a quick look at what the provision says. So the provision over here is that when the registration of person is cancelled and it is subsequently revoked by any appellate authority, tribunal, etc., so and so, then the input tax credit in respect of any invoice, debit note, was not restricted. If it was not restricted under section 16 subsection 4, or on the date of order of cancellation, the said person shall be entitled to take the credit in respect of such invoice or debit notes by filing a return under section 39, filed up to 30th day of November following the end of the financial year, or for the period of date of cancellation of registration to the effective date of cancellation within 30 days of the date of order. Now, obviously it was slightly tricky to really gauge what exactly was being meant by that. We have therefore tried to create a few illustrations to explain this particular portion. Now, let's see the first situation. So we are saying that let's assume a situation that A Limited has made a purchase during financial year 24-25. Now, normally, what would have been the last date of claiming credit in such case? It will be 30th November 2025. So we are talking about a fresh case. A Limited has made purchase, and for the financial year 24-25, ideal scenario mein, as per section 16 subsection 4, the last date to claim the credit will be 30th of November 2025. Now, in first situation, let's take an assumption. If the registration was cancelled during the financial year 24-25, say assume karo December 2024 mein the registration is getting cancelled. The revocation of cancellation is being done in the month of September 2025. Means cancellation happened in December 24, revocation has happened in September 25, but 24-25 के हर इनवॉइस एंड डेबिट नोट का क्रेडिट लेने के लिए लास्ट परमिसिबल टाइम एंड डेट क्या है? इट इज 30th of November 2025. So now the question is, was the revocation done prior to that 30th day of November? The answer is yes. In such case, all the input tax credit of any invoice or debit notes which were issued during the year 24-20, which were received during the year 24-25 for A Limited will have to be claimed by GSTR 3B returns filed up to 30th day of November 2025. 30th day of November 2025. Why? Because the registration cancellation as well as revocation has both happened prior to the date of, has happened prior to the last date of claiming credit. Okay. Now, we take a second situation. If the registration is cancelled after the end of financial year 24-25, so we are assuming that June 25 mein registration cancel hua. The revocation is done in December. Now you see what is the challenge over here. 24-25 का ideal time to claim the credit is up to what date? 30th of November 2025. We were restricted to claim the credit from June 25 to December 25. From June 25 onwards rather, because our registration was inactive, it was cancelled. In such case, they say, since the order of revocation of cancellation is issued after the 30th day of November 2025, you will be allowed 30 days from that order. Matlab 30 days after this date of, after the December 25 order is received, 30 days from that date tak you can claim the input tax credit by filing GSTR 3B returns. So they are in fact giving you a buffer time to claim the credit in case of cancellations, but उसमें लिए conditions यही है, if prior to 30th day of 30th November 2025 अगर registration cancellation and restoration उसके पहले ही हो जाता है, then the due date remains as 30th November 25. If the registration and revocation happens after that date, then it is within 30 days from that particular time. Now the only challenge over here is that if the registration is cancelled, let's say in December 25, मतलब 24-25 का आपका जो last date है वो अभी जा चुका है, बीत चुका है, because 30th November 25 has already gone. If registration is cancelled only in the month of December 25 and you restore it in February 26, तो and आपको अगर कुछ याद आता है अरे 24-25 का कोई क्रेडिट रह गया है, then will you be allowed to claim that? The answer is no, because the day when your registration is cancelled, in fact your time for claiming credit of 24-25 has already surpassed, so there is no further possibility of claiming credit for that year. Fair? So I hope this is clear. We move further. This is the provisions what Swapnil will be covering. So I'm skipping the waiver of interest penalty under 73-74 and also the proposed section 74A. Now, we are coming into the, so I'm going by the priority rather than the order in which the finance bill is running. Priority in terms of the impact which is going to be there on the industry. Now, additions in the Schedule 3, that is Schedule 3 to the CGST Act is where a supply amounts neither to supply of goods nor supply of services, means it is not a supply under GST. There are two additions which are proposed to be made under this Schedule 3. Now, these additions are in relation to the reinsurance business, but just because this reinsurance is slightly a conceptual thing, I have tried to create an illustration over here. Let's try to see this. Mr. K insures his cars, which is worth rupees 5 crores, and the insurance premium is 1,75,000 per year. Now, K has appointed insurance company X Limited as its insurance partner to do this car insurance. That is, the risk coverage of the car is being done by X Limited. Now, X Insurance Limited sees that, okay, there is a huge risk over here because the amount that they have covered is 5 crores. So this is just an illustration. So we are keeping the amount as 5 crores. So what does X Insurance Limited does? It does a ceding of risk, matlab transfer of partial risk to some other insurer. It does ceding of risk, that is passing of risk to some other insurer, which is, let's say, Messrs. Y Insurance Limited. So what does X Insurance does over here is that 50% of the risk it is willing to transfer to Y Insurance Limited. Means कल को जाके अगर कोई in the situation comes that there is a claim of this 5 crore rupees which is made by Mr. K, then of course for Mr. K the only person responsible to give that insurance is X Insurance Limited. But because X Insurance Limited wanted to partially part away with the risk, they had done a reinsurance of this vehicle to the extent of 50% value with Y Insurance Limited. So primarily in an insurance contract which is involving reinsurance, one thing is very clear, that the Mr. K has a privity of contract only with X Insurance Limited. X Insurance Limited has another contract with Y Insurance Limited, but Mr. K and Mrs. Y Insurance Limited have got no privity of contract amongst them. Now, reinsurance business and the commission on reinsurance, these are the two areas which were to be brought into the net of these Schedule 3 activities. Means those intermediate activities. Let's see what they are. Now, jab K is going to insure his vehicle and pay a premium of 1,75,000, there will be a GST levied on that by X Insurance Limited. So X Insurance Limited will send him an invoice of 1,75,000, charge a GST of 18% on that 1,75,000. But the transaction between Y Insurance Limited, which is going to get a partial premium share, and in return which is also supposed to pay commission to X Insurance Limited. So now when it comes to the transactions only between X Insurance Limited and Y Insurance Limited, which involves reinsurance transfers as well as the commission the commission amounts for getting this business, in both these circumstances these transactions are proposed to be put into the Schedule 3 of the CGST Act. If a condition is there, stipulating condition is that if K Limited if whatever business is being given by K Limited, means whatever premium is charged by whatever premium is charged to K, whatever the premium is charged to Mr. K, if that entire 1,75,000 gross amount is sufficiently covering these subsequent transactions, that is the commission as well as the reinsured amounts. In such cases, the intermediate transaction between the two insurance companies will be kept in the Schedule 3, subject to the condition on the full value which is given to the customer, which is inclusive of the commission, grossed up amount, etc. If the GST is paid, then the intermediate transactions will be kept in the Schedule 3, means on those transactions there will be no GST put up. I mean, there will be no GST levied. Now, of course, whenever there is something that comes in Schedule 3, there is always a bell ringing in our heads that, okay, Schedule 3 में अगर कोई चीज जाती है for the insurance company, let's say one set of business is reinsurance. If the one set of business is going in Schedule 3, then what happens to the common credit reversals in such case? Usually, wherever the common credit reversal under Rule 42-43 has to happen, there will always be a specific rule or a sub rule or a specific rule order in the rule which says that, okay, XYZ category of Schedule 3 transaction will not be considered for common credit reversal. In this case, there is nothing specific about it which has yet been mentioned. So that is still remaining a risk for the insurance companies. There is no impact on the insurance client or the insured person. There is no impact on him. This is only to do with the intermediate transaction between two insurance companies. All right. Now, thereafter, we have a certain amendment with respect to the chapter of, the section in levy of GST. Now, what exactly is the amendment in the levy portion of GST? That is, the charging section under CGST Act, SGST Act, UTGST Act, and IGST Act. The charging section is generally read as there shall be levied a tax to be called as Central Goods and Services Tax, etc., etc., on all goods and services except for alcoholic liquor for human consumption. Now, the alcoholic liquor for human consumption, in addition to that, there are two more products which are added, which are in fact the components which are used for manufacturing of alcoholic liquor for human consumption. Now, please remember, from the beginning, the only product which has been considered as non-GST product, which is non-taxable product at all, that is alcoholic liquor for human consumption. There is no other form of alcohol which is considered outside the GST purview. Now, there are two additions in this which will be considered outside the purview of GST. If undenatured extra neutral alcohol or a rectified spirit, if these are the two chemical based names which are given, which are generally the ethyl alcohols, etc. But if the undenatured or extra nutrified extra neutral alcohol or a rectified spirit, used for manufacture of alcoholic liquor for human consumption, will also be considered as outside the purview of GST. Now, very importantly, these products may have some other usages also, like alcohol in a general sense may have any other usage also. It can be phenyl, deodorants, etc. So the specific product which was excluded from the levy of GST was alcoholic liquor for human consumption. Likewise, undenatured extra neutral alcohol and rectified spirits used in the manufacturing of alcoholic liquor for human consumption will be excluded from the purview of GST. So if any company is manufacturing these components, let's say, if they are using it, if they are manufacturing it for the purpose of used in the alcoholic liquor for human consumption manufacture, only then they will be considered as not liable for GST. Now, of course, what happens to the distilleries or the liquor manufacturing companies? Till now, when these liquor manufacturing companies, let's say, were procuring these undenatured extra neutral alcohol or rectified spirits, तो उसके ऊपर का जो GST component है, that was becoming a cost to them. So there's a good news for them that there will be no additional burden of GST, because for them it was like a dead cost to the business. Of course, it will have an implication that there will be state excise and state VAT impositions there, but there is no explicit mention of that. But since it has been kept outside the purview of this, there might be an impact from the state excise perspective. Section 11A, now here there has been, section 11A particularly has been introduced to get in exemptions. But before, we'll just take a quick look at what the bill actually says with respect to section 11A. The 11 after the provisions for the exemption, there will be one section which will be added, which will be like read as this: notwithstanding anything contained in this act, if the government is satisfied that a practice was or is generally prevalent regarding levy of taxes, central taxes, including non-levy on any supply of goods or services. And such supplies were or are liable to central tax in case where the according to the said practice, the central tax was not or is not being levied, or a higher amount of central tax was being charged or levied in accordance with the said practice. Then the government wants to give an exemption in, government wants to, if they want to give an exemption in such case, they will get it under this section 11A. Now here there has been a slight discuss and debate about what exactly it is. Whereas we believe that the primary purpose is only to resort to a scenario ki wherever there has been no taxes prevalent earlier, but because of GST there has been taxes, or the taxes were less, but because of GST the taxes are more, and the understanding of the business in general senses, in common senses, is that the taxes were incorrectly charged or are incorrectly being charged. In such scenarios, if the government envisages anything coming under it, then the exemptions will be given through this section 11A. There is no express mention of which nature of business is going to get covered under this. It's just that they have opened up a arena for giving exemption, that normal provisions, exemption provisions are in section 11. But this specific reason say, if they want to forego a revenue or forego even a past collection, then the provisions of 11A will be used for making some notifications under them. Not a very, you can say, not a very day-to-day type of use provision from our perspective. It is more from the government's perspective, which will be giving them a rather the permissibility to give such exemptions. Now, one important case I would definitely want to discuss is about the applicability of tax under reverse charge mechanisms. In case of purchase of services, in case of procurement of services which are liable for reverse charge, the time limit for the time limit for paying tax under time of supply was earlier of the 3 dates, which was read earlier as date of entry in the books of accounts, date immediately following 60 days from date of issue of any document in lieu of invoice. This was read as earlier. So now it says that date immediately following 60 days from the date of issuance of invoice by the supplier, where the invoice is required to be issued by the supplier, which is in first place. This portion has been added. And C, the C portion is also added, which says that the date of issue of invoice by the recipient, where the recipient is supposed to issue such invoice. Now we'll first come down to some basics about this. In practical scenario, how many times have you seen that the taxpayers are actually issuing invoices for purchase of reverse charge based services? It is very less. It is very much less in number. Means usually क्या होता है कि okay, we know that okay, lawyer services have been taken, GTA services have been taken, so we just calculate the tax paid under reverse charge and claim the credit. But there is something called as a invoice for reverse charge, which is to be prepared and under section 31 clause F of the CGST Act and rules under rule 46, etc. But unfortunately till now we have not been really following it very closely or doing it very stringently. In GST audits which you might have faced by the department जो conduct हुआ था उसमें, when the audits were conducted, you found that okay, there were several RCM transactions on which the taxes was not paid or which was missed out to be paid. In all such cases also you have ended up paying the taxes and claimed the credit. Now you see there is something specific over here which has been brought in. The time of supply provision has been increased. The scope has been increased to add the date of C, the clause C over here, that is the date of issue of invoice by the recipient, where the recipient is supposed to issue such invoice. Means reverse charge में जो recipient के capacity में invoice issuance was earlier not given a very strict adherence to thereto. Now it is very much necessary that any recipient of services under reverse charge is going to be required to issue an invoice for receipt of services which are liable to reverse charge. 1. 31F में भी एक amendment लाया गया है to say that the invoice is required to be issued within a specified time limit which is prescribed by the law, which is yet to be notified. Which is yet to be prescribed. Means like in normal circumstances of services, you are supposed to issue an invoice within 30 days from the date of completion of service. Here also there will be now a time notified to issue the invoice. Matlab, as a recipient of services, if I am receiving any services which are liable for reverse charge, irrespective of whatever my supplier gives, I as a recipient of service, I am supposed to issue an invoice within a specified timeline, and on the basis of that invoice, I have to discharge the tax also and claim the credit also. So this is something very specific which is going to be required as a part of compliance, and therefore the time limit, once it is once it is prescribed in the rules, that sticking to that time limit will be very important. So अभी तक जो एक प्रैक्टिस रह चुका था कि ओके आरसीएम का मिस हो गया तो आज भी टैक्स भर के खत्म करो, द प्रॉब्लम इज now if you don't do that, that means you have not issued those invoices under reverse charge also, and वो कल को रिपोर्टिंग में भी अगर जाता है तो you are going to default in the compliance with respect to those invoice, which is going to attract the penalty for invoices, etc., etc. Now, whether this disbars you from claiming credit, if let's say you end up paying the GST under reverse charge after 3 years, there has been always a debate that reverse charge का tax आप कभी भी भरो उसका credit मिल सकता है. There are other schools of thought also, but strictly speaking, it is important that now invoice is required to be issued. It is to be issued within a specified timeline, and accordingly, your meter for tax starts from that very date because the time of supply is going to be attracted. So it has to be made like you are sticking to a strong position in the e-invoicing for outward supplies. Now there will be a compulsive invoice in case of inward supplies which are liable for reverse charge. Then we move to the next amendment. Now any of your clients who are taxpayers who are making supplies to government or government entities or the local authorities, in such cases the deduction of tax at source, that is the TDS deductor, it is the government who is supposed to deduct that tax at source when they are making the payment to you. Here when I'm referring tax deducted at source, it is as per section 51 of the CGST Act. This is purely a GST TDS. The government tax deductors have been constantly making defaults in their compliance, because of which आप वो TDS credit time to time देख नहीं पाते हो on the portal, and maybe you want to claim the refund or you want to use that tax credit, etc. You are not being able to do that very properly. Now, earlier the provision for the tax deductor was कि the month in which the deduction is made, you are supposed to file a return for that month or that period. Now, for the deductors, if you are having any clients who are government companies, local authorities, or you are providing services to any local authorities or any government tax deductors, such people will be now required to deduct tax and file their returns on every calendar month. On every calendar month. This is to ensure that the process is streamlined. कि जो suppliers to these people है, suppliers to the TDS deductors है, उनको time to time वो credit दिखेगा या amount दिखेगा, and either they will be able to claim the refund or they will be able to take that credit adjustment. So summons again will be taken up by Swapnil. Now there are only a couple of provisions more which I wanted to just do a touch base to. That was provision in regards to the amendments with respect to now in a lot of sections there is only a change that 74A has been substituted or inserted, so that I'm not really touching upon. There's one small amendment over here in section 140 with respect to the transition provision. Abhi आता actually बघितलं the transition provision time has gone long back. Still, what they have only said is that in section 140, the words even if the invoices relating to such services are received on or after the appointed day, the words whether the invoices related to such services are received prior to, on or after the appointed day shall be substituted. I'll first say what it is. On the transition, on the date of appointed date, मतलब 1st July 2017 में जब transitional credit we had taken up, whatever ITC, whatever SENVAT credit or input VAT credit, etc., was accumulated on 30th June of 2017. Whatever credit had accumulated on 30th June of 2017, that credit was allowed to be transitioned into the GST credit. In that also specifically, any input tax credit which was relating to the ISD invoices, service tax में तभी का जो ISD का concept तभी भी था, ISD invoices के बारे में there was some issue regarding those ISD invoices which were received or on or after the appointed date. So now the only clarity is that any ISD invoices which were received either before the appointed day, on the appointed day, or subsequent to the appointed day for the ISD services, the credit of that will be permitted. honestly speaking, this is like a very late kind of a thought which has been coming in, but there might be definitely there are a few litigations around this which are happening, because of which this has been touched upon. Yes, so we have touched on to the schedule 2 the schedule 3 transactions also, and of course with those respect to the with respect to those transactions which are there as a part of the amnesty, or not amnesty, the insertion of 128A, Swapnil will be anyways taking it up. So as far as the provisions which I had to go through, I think I'm done with it and I'm ready to pass on the baton to Swapnil. But just if anybody has any questions to discuss, we can take it up in the next 2 to 3 minutes, or else we will hand it over to Swapnil or Atharva. Yes. Any questions? Where will the RCM invoices reported in GSTR 1? See, as of now, there is, we believe that the utility is going to be amended to that effect, that these purchase based invoices will also, since they are getting a time limit assigned to it, they will be also added as a part of your GSTR 1 return. But as of now, we don't have, but they will be getting updated. And in fact, it will be a fun part till the time it doesn't get updated, because there is no compulsiveness to that compliance otherwise coming in till that point in time. Any other questions?
Yeah. So I think Atharva, you can.
Sure. So thank you so much, Omkar. We move on from one part of indirect taxation to another part of indirect taxation. So I welcome CS Swapnil Kolte. He is a CA and LLB by qualification. He's currently part of of the managing committee uh, members of Thane branch of ICI. He has been in the MCM since 2019 and is also former chairman of Thane branch of ICI. He's currently employed at a firm named TMSL, which is into indirect taxation practice and litigation. So, Swapnil, you can please go ahead and take the session. Swapnil, you're on mute. Swapnil, you're on mute.
Sorry, I'm just setting up my screen.
Yeah, so before Swapnil starts, I would like to also share with all of you that he has been recently nominated as in one of the nominations for the upcoming litigation phase in the International Tax Review Awards Asia Pacific. So we are very proud of Swapnil. He is hailing from Thane branch, and Swapnil, we wish you all the best for the awards that are going to take place.
Thank you so much. Thank you so much, Mangesh, and thank you for this opportunity. Good evening, ladies and gentlemen. I know it's a little late, but I'll just take another 20 minutes of your life, and I'll try to cover all those other aspects which will definitely impact us in our day-to-day advisory or day-to-day professional life. As Omkar has already covered most of the part over here, I have been left with a very few part which pertains to litigations, and this will have an impact over all the firms that are under the ambit of GST. So I'll just take another 15-20 minutes and not more than that. So please bear with me till then, and I'll ensure that every minute you are spending over here will be worthwhile. So moving on to the first provision, without any further ado, is the major change that has been brought over here is introduction of section 74A. So till date, ladies and gentlemen, what used to happen is that, okay, sorry. So till date, what used to happen is that whenever under GST regime, whenever there was a short levy, whenever there was an excess refund, or wherever there was a wrong utilization of ITC, For demands and recovery, there were only two provisions under the law. One was Section 73 and the other was Section 74. Now, Section 73 usually dealt with all those cases where there was no fraud, collusion, or misstatements. And Section 74 is the one which mainly dealt only in cases of fraud and collusion. Now, the basic difference between these two were the fraud and collusion part, but the implications and difference on the implications of these two different sections were very varied, especially when it comes to penalty and the period of limitation. So under 73, whereas the period of limitation to issue an order was 3 years, the same under 74, that is in the case of fraud, was 5 years. Penalty, whereas was 10% under 73, the same was 100% under 74. Now, there was a lot of litigation that was going on with regards to the period of limitation. I should not be covered under this because my period of limitation will be only 3 years and it should not be extended period of limitation for 5 years. And this has been something that has been going on through a very long time, right from the service tax era or the customs era, the excise era. This battle has been going on of the extended period of limitation. And a lot of these matters have reached the tribunal and have clogged the tribunal to a large extent. So to smoothen this and to reduce the litigation to that extent, a new section 74A was already been proposed in the 53rd council meeting. So most of the changes that have come in the budget are not surprising because most of these recommendations was already discussed in the 53rd council meeting. 74A being one of the major ones. Now 74A per se is applicable for which period? Then it is only applicable for all the period post 24-25. For all the previous period till 23-24, 73 and 74, that is the current governing provisions, will continue to be applicable. Now, whether it's a case of fraud or not, both are covered under 74A. So there was one more budget notification, that is under subsection 12 of 73 as well as 74. A provision has been inserted that these provisions of the law will be applicable only till 31st of March 2024. Post that, 74A is something that will come into picture. Now, there was a threshold limit that has been brought in, which was not there earlier, though it's a very minuscule one and practically would not be having useful to most of us. That is, say that no show cause notice will be issued if the value of tax involved is less than 1,000 rupees. Now, such threshold limits were not there before. Now, what you see on the screen is basically a comparison between 74A, the erstwhile 73 and 74. Now, the time limit, this is the major change that has been brought in. What is the time limit for issuance of a show cause notice? Now, the time limit to issue a show cause notice under 74A is 42 months from the date of filing of your annual return, or the last date of the filing of your annual return. So 42 months. Initially, what under 73, if you see on your screen, it's three. It used to be 3 years from the date of the order and minus 3 months before the date of the order. That is roughly around 2 years and 9 months is something that you had to issue a show cause notice. And similarly, under the 74 provisions, it was 60 months minus 6 months, that is 54 months within which you had to issue a show cause notice. Now, in all cases, 42 months is the only time that you have to issue the show cause notice. Now, moving ahead from that, what is the time to issue an order? So initially, the time to issue an order under 73, 74 was 3 years and 5 years respectively. But under 74A, the time limit to issue an order is roughly what has been given under the law is 12 months from the date of SCL. That is, supposedly a show cause notice has been issued on the 1st of January 2025. Then before December 2025, an order has to be issued in that regard. Now, the same can be extended further by a period of 6 months. So if you see 74A has somewhat given two different distinctions, have broken up the whole things and have brought the timelines to 60 months, which was the earlier case of, that is of 5 years, which was the earlier case of 74. So the timelines is 42 months to issue a show cause notice. And after 42 months, within 1 year, you should issue the order, which can be extended by 6 months. Now, the only reason that I've been repetitive about these, because this is something that is going to affect each and every one of us. Now, further what is the difference over here? So penalty under 74A in cases where there is no fraud. Now this is very similar to 73. Now the penalty provisions have not much changed, and it is very broadly very similar to the previous provisions of 73 and 74, rather giving some extra days to make the payment and avail the benefit of concessional penalty or a waiver of penalty. Now under 74A, if there is no fraud, like earlier days 73, you had 10% of the tax amount or 10,000 rupees, whichever is higher. So if no fraud, 10% or 10,000, whichever is higher. And in case of fraud, you have the penalty amounts goes up to 100% of the tax amount. Now, if I go forward, is there any waiver like there used to be in the earlier provisions of the law? So supposedly, if before issuance of the show cause notice, the taxpayer identifies a problem, goes ahead, pays the tax plus the interest before issuance of the show cause notice, then there will be no penalty levied upon him. The only clause that has been brought is that you have to give an intimation to the tax officer in writing that you have made the payment. Now, post this, there is another provision which says that supposedly the show cause notice has been issued in this regard. Now, if you pay within 60 days of issuance of the show cause notice, tax plus the entire interest. Ladies and gentlemen, if you pay only the tax and interest is not being paid, you would not be eligible for this reduced penalty amount. So till 60 days post issuance of a show cause notice, if at all the tax and interest has been paid, there will be a complete waiver of the penalty amount. Okay. Now, what if I go ahead? Now, in case of fraud, okay, the case we discussed was only cases where there was no fraud. In case of fraud, a 15% penalty will have to be paid. Okay. Now, even if this is done before the issuance of show cause notice, if you have paid tax and interest, if there is a term, if you have been qualified and if there is a fraud alleged in your case, fraud suppression has been alleged in your case, then in that case, you will have to pay 15% of the reduced penalty. Now, what if the show cause notice has been issued in this case? Supposedly a show cause notice has been issued, and after within 60 days of the issuance of show cause notice, you pay the tax amount plus the interest amount, then your penalty amount gets reduced to 25% of the tax demand. Now you go ahead, you get an order issued, you still don't pay after the issuance of the show cause notice, an order has been issued to you. Now, if you pay within 60 days of the issuance of the order, then you have to pay 50% of the penalty amount. Tax plus interest has been paid, the 50% of the penalty amount will be reduced. Earlier, this payment gap used to be of only 30 days. So now you have a provision to issue of 60 days to pay the amount post issuance of the show cause notice or the order. Now, what is important over here to notice is that if at all the department has gone into an appeal, supposedly, in this case, if you see in most of the cases, 74, whenever they're issuing your notice, the department are not generally alleging what kind of fraud, what kind of misstatement has been done by you, or what kind of suppression has been done by you. They only allege tax has been suppressed, and they very blankly issue you a show cause notice under 74. Now, under 74A, they will have to go and mention what kind of fraud you have done. Just giving a statement would not give them a free hand to provide you with a higher penalty over here. Now, for the first time under the GST law, the term suppression has also been defined. This was not there earlier. So, explanation 2 to 74A, the term suppression has been defined, and this term suppression says suppression shall mean non-declaration of facts by a taxable person which he was bound to declare in his return or statement or any report, or fails to furnish any information which has been asked by the proper officer in writing. So if supposedly you have given any wrong information or you have not disclosed any information, supposedly your RCM was to be paid by you and you have not disclosed that in your returns, then in that case, that will be considered a suppression of facts. Now, another question over here, and which might again come up for litigation, what if you have not filed your returns on? Will that also amount to suppression? Because this only talks about non-declaration of suppression information in your return. So will the same logic be utilized or used when you have not filed your return is something that the law will test ahead and tell us. Now going ahead to the next change that has been brought, and again, this is something that will impact a lot of us. Ladies and gentlemen, Section 70 gives the power to the tax officers to issue summons. If you see the anti-evasion, the DGGI, even state authorities, the investigation wings have been issuing summons to a lot of large entities and even the small entities. Now, under Section 70, as per the current provisions, the person to whom summons has been issued, only he can appear or he has to appear before the law. There is no other person who can appear on behalf of him. Though a lawyer and advocate can be present with him, but the person whose statement has to be recorded is the person to whom summons has been issued. Now, this litigation was going on for a very long period of time, especially in the corporates where the managing directors or the CFOs who have been directly issued notices or summons. Now, in large entities, managing directors, CFOs, or even in private limited companies, the managing directors and the CFOs or the top officials are not usually aware about the nitty-gritties that is happening at the lower level or with regards to the GST. They are not very much accustomed to it. So when they used to go for summons proceedings, they used to give some statement and show cause notice or an order was been issued basis those statements recorded by them, which they were not very sure of, which was used against them. It had given a rise to huge litigation. Now, again, a lot of representations were being made in this regard. A lot of writ petitions will be filed. Around one of those such writ petitions was filed by the Gale Gas Limited versus DGGI before the Delhi High Court, wherein the Delhi High Court had very categorically observed that the CFOs and the MDs are not really aware about the nitty-gritties. So CFOs and the MDs should give a list of people to whom who are aware about the matters of the DGGI, what DGGI is investigating, and DGGI then should choose among those individuals and should give summons to only those particular set of individuals. Now, the law has been amended to say that even the authorized representative can appear for a summons proceedings on your behalf. The word uses the authorized representative can be allowed to appear, but again, there is a catch over here. The discretion is still with the officer whether to allow this or not. But still, there is a provision under the law which will allow an authorized representative in this case to allow you or not. So supposedly, when this law becomes effective, you have been issued a show cause notice. And if you think someone else in the company can be a better representative, the tax head or the accounts head, write a letter to them that you're not aware about the matter and use this particular section when it comes into when it becomes effective. Now, moving on to the next sunset on the anti-profiteering, Omkar has already spoken about it. I'll just cover it in brief that anti-profiteering was being brought up in the early days of the GST, and it was initially brought up for 3 years, which was later extended. And the only intention behind it was that if at all there has been a cost reduction due to the change in tax between the erstwhile law and the current law, then that benefit should be passed on to the consumers. Now the bench have put a sunset clause. This is in as per the council meeting, and also 53rd council meeting had given a date of April 1st, 2025, where no new receipt or no new application will be heard for the anti-profiteering cases. This was a much needed one. Now going ahead again, they have to fasten the process. They have given the power to the principal bench of GST, appellate tribunal that sits in Delhi. They are also empowered to hear upon the matters of anti-profiteering, not only appeals, but right from the the verification and the adjudication process can be carried on by them and heard by them for the applications of anti-profiteering. Now, this is again an important one, which will again impact most of us. Now, the timelines, this is regarding your pre-deposits for before the appellate authorities and your timelines to file an appeal with the GSTAT, that is the GST Appellate Tribunal. Now, there was a lot of hue and cry against the timelines has not been, the GSTAT has not been formed. So the timelines has not been triggered. So very recently, the retired judge had taken the position of the president of GSTAT, and the GSTAT, the president has entered the office. But there was again, has the timeline triggered for filing of your appeals. So again, a contradictory circular was been issued, Circular 224, very recently on July 11, 2024, which stated that if the recovery proceeding should not be initiated against an order under Section 107 or 108. So under the first appellate authority, so what happens? Show cause notice is issued, then an order has been issued. Against that order, you file an appeal. That is against an order in original OIO, you file an appeal with the appellate authority. Appellate authority will issue an OIA under Section 107 and 108. Against an order in appeal, you can go and file an appeal with the GSTAT. Now, the GSTAT was not formed. but a lot of commissioner appeals had already given up their orders. So, the timeline to file an appeal is only 3 months from the date of the order of the appellate authority. So there was a lot of confusion for whether my timeline has been over or whether the timeline has been started. So section and a lot of recovery proceedings was being started after such orders also by the department, stating that the order has been passed negatively by the appellate authority. So kindly pay the taxes. Now, in this regard, Circular 224 was been introduced, and which stated that if at all you want to stop the recovery proceedings, then the pre-deposit, whatever pre-deposit which you are going to pay to file an appeal before the Gestat, should be paid in a manner, not through DRC 03, should be paid in a manner as prescribed under the circular. Now, what had happened, a lot of us have not paid the taxes, assuming the timeline has not yet initiated. Now, what is the state of that affair is something that will come under dispute, and Circular 224 has already been challenged and will be tested again. So coming back to the topic, the timelines to commence of 3 months to file an appeal will commence from the date specified by the government. Now, this has come under the finance bill. So in our, so still the timeline is not yet started. It will come from the date that they will notify. And this provision specifically will come into effect from August 1st, 2024. From August 1st, this provision will become applicable. Now, there has been reduction in the pre-deposit amount. Ladies and gentlemen, I'll take your attention over here because this is an important one. So when you file an appeal before the appellate authority, your maximum pre-deposit was 10% of your tax demand. Tax demanded का 10% आपको pay करना था. Now the maximum of that, there was a maximum cap that was given to 25 crores. So up to 25 crores is something you had to pay under the CGST, and after you count SGST, it used to become 50 crores. Now the percentage is still the same; it still takes 10%, but the maximum amount has been reduced to 20 crores. Now, Gestat appeal. Now, this is something that is a very beneficiary provision that have been brought in. This is to encourage transparency and litigation and ease of doing business. Now, under the Gestat, you had to pay 20% of the amount of your tax amount. Now, this was over and above the 10% you paid at the appellate authority. So, total tax, if you would say, used to go up to 30% to file an appeal with the Gestat. Now, the 20% has been brought down to 10%. Now, 10% of the amount of tax in dispute is something that you have to pay. Initially, under 20%, your maximum limit was 50 crores. Now, under the 10%, the maximum limit has been brought to 20 crores. So, maximum amount under the GST law, the pre-deposit that you have to pay is 20%. Now, there was a notification that was being brought in between. That was an amnesty scheme to filing an appeal, where it had stated that if you want to file an appeal, pay 2.5% extra. That is 10% of the appellate authority plus 2.5% pay कर दो, then आपका अगर appeal time बार था तो वो accept किया जाएगा. Now, against that order, if you go to adjust that, remember you have to pay balance only 7.5%. Do not pay 10% more. So the total pre-deposit is only 20% that we have to pay. Similar provisions has been brought under the IGST law, stating that capping up the 20% to 10%, and the 20 crore limit has been capped to 40 crores limit. Now, amnesty scheme, this is the most important one again for most of us. All our clients, there was an amnesty scheme that was being announced, and under the 53rd Council meeting. This is for the period 1780, 1819, and 1920. Now, there are other amnesty which Omkar has already covered, where under 16.4 cases, the timeline has been extended, that already has been resolved. Now, this is an amnesty that has been brought specifically for Section 73. Section 73 are all those cases where there is no allegations of fraud. Now, under the amnesty scheme, what has been stated that if the tax amount has been paid by you, 128, Section 128 has been inserted under the CGST Act, and it states that if the tax has been paid by you, then the interest and penalty will be waived off. Tax अगर pay कर दिया है, interest and penalty आपका waive off हो जाएगा only for 73. Now, the only condition over here is that you have to withdraw your appeal or writ, whichever is filed. Supposedly, there is only a show cause notice that has been issued to you. In all these cases, the timeline to issue an order has also gone up. So there will be an order also for 17 and 18, 19. Assuming there is a show cause notice issued, assuming there is an order in appeals, order in original that is pending, if there is an order in appeals that is there, all those cases, ladies and gentlemen, even if you have gone for an appeal, you can pay off the tax amount and your interest and penalty would completely be waived off. But you have to withdraw those appeals and you have to withdraw those appeals or writs, then your penalty and interest will be waived off. The date under the 53rd Council meeting for this was the 31/03/2025. अब तक डेट जीएसटी लॉ में नोटिफाई नहीं किया गया है. द काउंसिल हैड रिकमेंडेड कि 31 मार्च 2025 तक आपने अगर पे कर दिया तो आपका इंटरेस्ट एंड पेनल्टी माफ कर दिया जाएगा. Now there can be one more case. Supposedly a section notice has been issued in 74. You go for an appeal against that. Once you go for an appeal, the appellate authority states that okay, there is no case of fraud and the matter has been remanded back under 73. In that case, also you can opt for this particular benefit and you can pay off that liability over here. Now, the only question that will come over here, what if a show cause notice has been issued for multiple years? What if a show cause notice has been issued for the period 1920 to 2023? Then can I avail benefit? Then what we would suggest, what I would suggest, still the fine print has to come out. What you could do is you can pay the tax amount pertaining to 1920 and automatically the interest and penalty for 1920 should be dropped. So these some complications should come ahead that we can expect some changes and detailed notifications and instructions to come in this regard, which will show the nitty-gritties of how this is to be handled. I believe Omkar has already covered this, but Section 54 has an amendment which states that no refund on zero-rated supply of goods. Again, if supposedly you're making an export of any goods on which export duty is levied upon you, that is, अगर BCD आपके exports पे लग रहा है, in those cases, usually BCD is not applicable on exports unless and until the government wants to discourage export of those goods or commodities. In those cases, you cannot claim a refund because the intention of the government is any which ways to not allow the export of such goods or to de-promote the export of such goods. Then if at all your zero-rated supply is such that it's subject to export duty, then refund shall not be allowed. Under second proviso of 54(3) was only barring refund of ITC in these cases. So in a lot of cases, people would claim refund by paying the IGST. So this mischief have been stopped, and similar changes have been brought under the IGST Act, where it is stated that refund will be dealt as per 54 of the CGST. I believe this is the second last, so I'll just take another 1-2 minutes to conclude with it. I know we are about time. I'll just take 1-2 minutes. Section 122(1)(b), not applicable to most of us. So 122(1)(b), Section 122 is the penalty provisions under the GST law. So earlier the penalty provision was been introduced for the 122(1)(b) was been introduced very recently in the Finance Bill 2023, and wherein it was stated that any electronic commerce operator, there are 3 clauses. If he is not adhering to it, then penalty would be levied upon him. Now the change has been made that all electronic commerce operator who are subject to collect TCS, tax collected at source, under Section 52, for only them, those penalty provisions will be applicable. The last that I'll be covering over here is for the erstwhile law. If the matter is of central excise and service tax and excise, this is not from the SSC point of view, but this is from the revenue point of view. If the matter is the existing monetary limit, if the matter was above 50 lakhs, then the revenue can go to the department, go to the SESTAT for an appeal. If the matter was above 1 crore, they can file an appeal with the High Court. And if the matter was about 2 crores, then the appeal can be filed with the Supreme Court. Now, to reduce the litigation, they have reduced this limits for excise and service tax laws, and they have stated if the department wants to file an appeal, the matter should be about 60 lakhs for the SESTAT, 2 crores for the High Courts, and for Supreme Courts, it's 5 crores. The only intention over here was to reduce the litigation that department might go into, and was to complete all the litigations pending under the erstwhile law. Omkar has already covered the ethanol, the extra neutral alcohol, so I will not delve into that. So that's it. If there are any queries, I'll be happy to help. But Section 74A, I would request everyone to just read it once, and Section 72, because that is something that will be applicable to all of us. That's it from my side. If you have any queries, me and Omkar are over here. We can take up your queries, or else I'll ask Atharva to take it up from over here. Atharva?
Thank you, Swapnil. I think Atharva is not in the meeting.
Okay.
May I now request CA OP Singh, our committee member, to give a formal vote of thanks, and then we can move ahead to conclude our today's session.
Thank you, Mangesh. Very good evening to all of you. I, CA OP Singh, Managing Committee Member of Thane Branch, take this opportunity to give vote of thanks for this session. First of all, I would like to thank to our own young and dynamic speakers, CA Omkar Gargil and CA Swapnil Kolte. Though they are also host of the event as a committee member, but it's our duty to acknowledge their efforts for sharing their expertise with us. We understand that just 2 days ago, budget has been presented, and presenting such a session within 2 days is really appreciable. Though it's difficult to explain the whole budget in such a short time, but you both have covered all the points and presented the same in a very simple and lucid manner. Thank you, both of you. I would also like to acknowledge the efforts of our branch staff who has worked behind the scenes and ensure the smooth conduct of this event. Last but not the least, thank all the participants. You have taken out time from your office work during the time of ITR filing deadlines. Thank you once again to everyone who has contributed to this wonderful session. Thank you.
Thank you. Thank you, CA OP Singh. I formally announced that the session has been concluded, and thank you all of you for joining, and see you soon in some or the other physical session of Thane branch. Thank you so much. Thank you so much.